Here we go. One step at a time, don't be living on the line.
In today's lesson, we're going to look at a perfectly competitive firm and a perfectly competitive market and ask the question, when should a firm shut down rather than staying in the market? So in a previous lesson, we showed that in order for a perfectly competitive firm to maximize its economic profits, it should always produce at the level of output at which its marginal revenue equals its marginal cost. For an explanation on this concept, make sure you've watched that previous video lesson. In another lesson previously, we showed that in the long run, a firm in a perfectly competitive market will earn only normal profits. In other words, it will earn zero economic profits. We can see that this firm, in our graph on the right, is only breaking even at the current level of output and the current price determined in the market for this firm's product. This firm is not earning any economic profits, but it is earning a normal profit, meaning that the owner of this firm is perfectly happy to remain in the market since it's not only covering all of its explicit costs, but it's also earning a little bit of profit for the owner. So on our graph, there is no economic profit illustrated. Now in this video, what we're going to determine is when would a firm such as this choose to shut down and close its business rather than remaining in the market at all. Clearly, what would happen if the demand for this firm's good increased was that it would go from breaking even to earning economic profits. A firm earning economic profits clearly does not want to leave the market, rather it wants to continue to earn those profits. So we're not even going to bother to show what would happen if demand for this product increased. What we'll look at instead is what will happen if demand for this firm's product decreases, because that's what's going to cause the price that the firm can sell its product for to fall and may lead this firm to leave the market in the long run. So let's look at our graph on the left. We're assuming that this firm is one of 1,000 firms selling an identical product to the other 999 firms, and that the price for this firm's product is determined by the demand and supply for the good in the market. What would happen if the demand for the product that this firm is selling decreased? Let's show the effect of a decrease in demand for this firm's product in our graph on the left. Let's assume that demand falls from D to D1. The good is less popular among consumers now, or a cheaper substitute came along. Perhaps the incomes of consumers fell. Any one of those things could have caused the demand for this product to decrease. In our graph, this product now becomes less scarce, therefore the equilibrium price in the market decreases. We'll call this P1. Now, since individual firms in this market are price takers, this decrease in the equilibrium price shifts the individual firm's marginal revenue and demand curve downwards. So we can draw a new marginal revenue and demand curve below the original marginal revenue and demand curve. MR and demand for the individual firm's output has decreased due to the fact that there's less overall demand for this product in the market as a whole. So we'll call this new curve MR1 and demand 1. So looking at our graph on the right, we can see that the firm has a lower demand for its individual product since it is one of 1,000 firms in this market and there is less demand for the overall output in the market as a whole. Now, what will the individual firm do as demand for its product falls? In order to maintain its profit maximizing level of output, the firm must produce where the marginal revenue equals the marginal cost. So we can see that the marginal revenue has fallen and we have moved down and to the left along this firm's marginal cost curve. Therefore, the new profit maximizing point, MR equals MC, is at a lower level of output. So we'll draw a dotted line down here and we will we'll acknowledge that this firm, a profit maximizer, will have to produce where MR equals MC, which is at a lower level of output. Now let's examine the effect that this fall in demand had on this firm's profits. Actually, before the demand decreased, the firm was earning no economic profits. Now the firm is in even worse shape. The firm is now earning economic losses. So if we continue our dotted line up to the average total cost curve and over to the price and cost axis, we can now see that this firm's average total cost at a quantity of Q1 is greater than the price it can sell its product for, the average revenue. If average total cost is greater than average revenue or price, by definition, this firm is earning economic losses. So we're going to shade the area that represents the economic losses that this firm is earning. The yellow rectangle represents the losses earned by the firm resulting from the decrease in demand for its product among consumers in the market. So the question then is, should this firm shut down? Should this firm continue to produce the goods it's producing, or should it shut down? Now, you may say, it's an easy answer to that. The firm is earning losses. Why would it want to continue to produce this good? Well, the question then is, if the firm shuts down, what does the firm lose? And how does the losses of shutting down compare to the losses the firm is earning if it stays in the market and continues to produce? To answer that question, we need to examine the firm's fixed costs. Why do we examine fixed costs? The fixed costs a firm faces are those which it must pay regardless of its level of output. This may include the rent that the firm owes to its landlord if it is renting factory space, for example. This includes the interest that the firm must pay on capital that it acquired before it ever started producing in the first place. These are costs that must be paid whether the firm is producing 1,000,000 units or 0 units. In other words, if a firm shuts down, it still must pay its fixed costs. That's right. If the firm shuts down, it loses its fixed costs. This would be a loss to the firm if the firm were to shut down. The landlord does not care whether you are producing 1,000,000 widgets or 0 widgets. The bank does not care how demand for your product has been affected. It wants to be paid back for the capital that it lent you. So where on this graph can we show the firm's total fixed costs? That's the question. We're going to compare total fixed costs to total losses of remaining open. If the firm shuts down, it loses all of those fixed costs that it must pay regardless of its level of output. If it remains in operation, it loses what it's losing, the average revenue minus the average total cost, which is negative in this case. So let's look at our graph and examine where on this graph we can find the area representing total fixed cost. Well, also in a previous lesson, we explained that at any level of output, let's just choose a random point out here. We'll call this QX. At QX, if we wanted to know the firm's average fixed costs, we could just find the difference between its average variable costs, which are right there, and its average total costs. So at any level of output, the difference between ATC and AVC is the average fixed cost. Now, if we know the average anything, we can pretty easily determine the total of that thing. If we can find the average fixed cost that the firm experiences at a quantity of Q1, and we multiply the average fixed cost by the quantity Q1, we can show on this graph the area representing the total fixed costs. So let's do that. We have at Q1 an average fixed cost of ATC, we've already labeled ATC right here, minus AVC. So if we go up to the average variable cost curve and draw a dotted line over, this is the firm's average variable cost. You'll recall that average fixed cost equals average total cost minus average variable cost. So that's simply the difference between the ATC and the AVC. That is our average fixed cost. So now that we know the area of average fixed cost, we can very easily find the area representing the total fixed cost. And that is simply the yellow rectangle, which is the firm's total losses, plus an additional area represented by the blue rectangle. So in our graph here, the blue plus the yellow represents the total fixed costs. So that entire rectangle, blue and yellow together, represents total fixed costs. The total fixed cost is what the firm will lose if it shuts down in the short run, because it will still have to pay those costs. So should this firm shut down? That's the question we're trying to answer here. Clearly, this firm should not shut down. demand is still high enough that its total losses it will experience if it continues to produce its good are less than its total fixed costs, which it will lose if it stops producing this good. We have just shown an example of where a firm should not shut down. It should continue to produce this good in the short run and hope that other firms shut down and that demand for its individual product increases, allowing this firm to go back to a break-even level of output. So we have just shown that this firm is not yet in a situation where it should shut down. It is in a loss minimizing position. It is minimizing its losses by producing at the MC equals MR point. So what would have to happen for a firm to actually have to shut down? We're going to clean up our graph here and show one more shift in demand that would result in a situation in which the firm would be better off shutting down. Here we are back at our original equilibrium in the market and the firm diagram. Next, we're going to illustrate a situation in which demand decreases by more than it did in our previous illustration. Therefore, the marginal revenue demand as seen by the individual firm is too low for it to continue to operate in the short run. So we'll start with a decrease in demand in our graph on the left. This time, we're going to show demand decreasing by quite a bit more than we did before. Let's say this product has become really unfashionable. I usually use the example of cassette Walkmans, the portable cassette players that we all used to carry around when we were little kids, but nobody seems to carry around anymore whatsoever. Lots of companies made cassette Walkmans back in the 1980s and 90s, but today you can't find them anywhere. This is because they have simply been replaced by CD players and MP3 players. So as demand for cassette Walkmans fell, eventually it became so low that the price of these things was really low. So we've got a new demand curve really far to the left. Hardly anybody demands Walkmans anymore. This means the price is going to be very low for them in the market. We've got a new price of P1. And of course, since the producers of these products are in a competitive market, they face a horizontal, a perfectly elastic demand curve determined by the equilibrium price in the market. So the individual producers will face a very low price resulting from this significant decrease in the demand among consumers of the good. So we've got a new demand curve for the individual firm's product called MR1 equals demand. As you can see, we're in a tricky situation here because according to the profit maximization rule, firms should produce where marginal revenue equals marginal cost. But what if marginal revenue is lower than marginal cost? All we can say is that the firm would probably want to produce where its marginal cost is lowest, which is right here. So let's say a firm chooses to produce at that level at a quantity of Q1, and it will face an average total cost that is, as we can see, significantly higher than the price of the product. The firm's total economic loss in this case is ATC minus AR, or price, times quantity. The yellow rectangle now represents the area of economic losses the firm will experience if it continues to produce its product. The firm, at its best possible level of output, is earning very large economic losses. But are they large enough to necessitate shutting down, to make it in this firm's best interest to actually close its doors and get out of the market? To answer that question, we should, again, compare the firm's total losses to its total fixed costs. And once again, we can determine total fixed costs by finding the difference between ATC and AVC. That gives us our average fixed cost, and multiplying that by the quantity. That gives us an area of total fixed cost equal to the green rectangle. The firm's total fixed costs are equal to the green rectangle. This is what the firm will forego if it shuts down. It will still have to pay its rent, and it will still have to pay the interest on its capital if it shuts down. However, as we can see, the total fixed cost in this case is now less than the total loss the firm would experience if it continued to operate. So the green rectangle represents total fixed cost. And as we can see, that is less than the total loss of operating. This firm should shut down. This is the shutdown rule, in fact. If the total fixed cost is less than the total loss, the firm should shut down. This, ladies and gentlemen, is the shutdown rule. A firm can continue to operate as long as its total fixed cost is greater than the total loss that it is experiencing when producing at its profit maximizing quantity. However, if the total loss experienced by remaining in the market exceeds the total fixed cost, then the firm can minimize its losses by shutting down, paying the fixed cost that it still owes, rather than continuing to operate and going into further and further debt by doing so. It would make no sense for Sony or any company to continue to produce Walkmans in the year 2012. There is just not enough demand for Walkmans, yet the fixed costs of maintaining a Walkman factory are too high. In fact, I remember reading recently that Sony shut down its last factory producing portable cassette players in the last year or two. Why did it do this? Clearly, the global demand for such products was lower than it needed to be in order to cover the firm's variable costs. The firm was better off shutting down those factories and giving up the fixed costs that were involved in the production of portable cassette players. So that wraps up our lesson on what we call the shutdown rule. If a firm is earning losses that exceed its total fixed costs of production, the firm can minimize its total losses by shutting down in the short run. As some firms shut down, the supply of the good will decrease in the market, causing the price to rise, allowing other firms to break even once again in the long run. But as we can see here, using our Walkman example, some goods just don't get produced anymore. That wraps up this lesson on the shutdown rule. When you combine this with our two other lessons on the profit maximization rule and the lesson on short run and long run in perfect competition, you've got a pretty good idea of how perfectly competitive firms interact and how they make decisions in both the short run and the long run. Thanks for watching, and we'll see you soon.